Welcome, Nebraska, to this week's episode of the Retirement Compass, brought to you by the team at Stonebridge Wealth Management. I'm your host, Kristen Oakley, and I'm joined in the studio by Tim Kulhanek. He is founding partner and financial advisor, and Jeremy Gove, senior financial advisor. Gentlemen, I am so excited to be back with you. I know we've been doing the show for a little while now, and people have been calling and coming in and meeting with you for the first time. What's it been like? I know you've been really busy.
Yeah, it's been a lot of fun. Between the radio program and now the television program, it's neat making connections with people. That's, I think, the number one reason why Jeremy and I are in this business, is to help people, but to make relationships and create long-lasting relationships. And it's fun if you're out to dinner with your family or at Honest Abe's or something like that, grabbing a burger, and you see folks that
they
strike up a conversation.
You, right?
Yeah, it's cool. Yeah,
That's awesome. Do you enjoy the recognition, Jeremy?
The recognition's okay, but like Tim said, building the relationships is a lot of fun. We really enjoy that.
Absolutely, for sure. Well, and if you're new to this show, you are in for a treat. Not only do Tim and Jeremy pack this show with such valuable content that can really help you plan for your retirement successfully, but they also are a wealth of knowledge and fun stories and analogies, and I love it because I never know what you guys are going to say. So
we don't either.
Right now. Well, you have put together a great show today. We are calling this show, You Have Saved and Put Money Away in Tax-Deferred Accounts for 40 years. Now what? Because that's the reality. So many Americans have been working hard and saving and accumulating and putting money away in their workplace retirement plans, things like 401ks, 403bs, TSPs, maybe individual IRAs as well. And the question is, a lot of people did that because we were sold, and we've talked about this on previous shows, back when they created these accounts. Yep. It was put the money away now, right? Yep. You don't have to pay the tax. You'll get a tax deduction today. But is that really true? Now, in today's economic environment, are we really going to save ourselves money in the future on taxes, having deferred and kicked that tax can, if you will, down the road for so long?
Yeah, well, it's a great question, Kristen. And the thing that I think so many CPAs talk about is, let's defer the tax, let's get the deduction today, and because you're probably going to be in a lower tax bracket down the road.
Right.
And I always, when you stop and just think about that concept, who wants to be in a lower tax bracket down the road? I mean, if you're used to the standard of living that you're living in today, do you want that to decrease down the road? No. I mean, I don't know anybody that wants to retire and then not be able to travel, not to be able to do things that you were doing while you were working. And so I just, every time I hear that, it just kind of strikes me wrong, because that just doesn't make sense to me. I want to be at least in the same tax bracket I was in. And the other thing that I guess people need to think about is, and this is where the planning really comes in, is what are the tax brackets going to be? I have no idea. I might be in the same tax bracket, but that percentage may be way higher. And I think we'll hit on that as we go through the show today.
Absolutely. Well, I know one of the things that sets you and the team at Stonebridge Wealth apart is that you all engage in strategic tax planning.
Yep.
So before I ask my next question, I was just wondering if you could explain a little bit of what you mean by that, the difference between tax preparation and tax planning.
Yeah, I think it really comes down to whether you're acting as a historian and looking backwards, or if you're looking out into the future and preparing for what's to come. When we talk about tax preparation, I work with a CPA to prepare my own taxes, because it's really complex and it's above and beyond. I'm not a CPA, right? Yep. And he asks for my 1099s, any W-2s, ask what deductions that I might have, charitable contributions, and he tells me, hey, here's how much of a check you got to write to the IRS. That's like the worst day of the year, right?
Right, it's never fun.
But again, that's looking at what happened last year. What tax planning is it's totally different. I'm looking for our clients, this is what Jeremy and myself and our team of lead advisors here at Stonebridge do, is we say, what is this going to look like in 3 years, 5 years, 10 years? Now, there's some things that we know. Okay, we know that in 2017, Congress passed the TCJA, Tax Cuts and Jobs Act, and it reduced brackets and it broadened them out. Okay, so it did a lot of different things, and we can do future shows specifically on what's changing.
Right.
But take it, for example, the rates Jeremy's just talking about. 15% went to 12%. Okay, 25 went 12 into 22. So 22 will go back up to 24, and so forth. So we had cuts, but we also have more income that we can have and stay in a lower bracket. And we know that that's changing at the end of 2025. So those rates are good through 2025.
That's when the current tax code will sunset.
Yep.
Exactly. So changes are coming that folks need to be prepared for.
Right. So if someone's watching today and they're thinking, well, gosh, I did what I thought I was supposed to do. I have saved so much money in a 401k, a workplace retirement plan, and now I'm getting ready to retire. Is it too late for them to begin engaging in strategic tax planning? What would you say to someone who's concerned about that?
I would definitely say it's not too late because, even if someone's, let me take a step back. We all know that time is either our friend or our enemy when it comes to planning for retirement, right?
Right.
Because the main thing is compound interest. I think it was Einstein that said compound interest is the eighth wonder of the world.
Yes.
He who gets it, or he who understands it gets it, he who doesn't pays it. So yeah, it's great if we can get started early. But when it comes to tax planning, one, if you've done a good job saving, it's more critical than ever.
Right. Yep.
If you haven't maybe done the job saving that you should, there's still time, there's still opportunities. I mean, with the way that contribution amounts work this year, you can put $6,500 into, say, a Roth IRA. You can, if you're over 50, you can do another $1,000 for $7,500. You can put $30,000 into a 401k at work.
If you're over 50, right?
Yeah, if you're over 50, thank you. And then if your workplace has what we call a match, you might get another, 3% or 5% on top of that. So you can start socking some good money away. But there's no way for us to know whether that should go to a pre-tax side or a post-tax, like Roth side, unless we can look at someone's individual circumstances. Because again, mileage may vary. For someone that is a really high earner, it might make a lot of sense to do a pre-tax type of contribution because maybe you are in one of the top tax brackets. The top two tax brackets would be an example. But for those middle income folks, that's something we really got to think about because once we get to retirement and all of a sudden we're looking at the fact that just the interest alone on the national debt year over year has gone up about 20% because of the rise in interest rates. That's unsustainable. And there's really one way that Congress can claw that money back, and it's through rising taxes. So it's time to prepare.
Yep, for sure. Well, you mentioned the word Roth, and I know that a lot of folks now have this option in their workplace retirement plans. They don't just have a traditional 401k, for example, they also have the option of contributing to a Roth 401k. So given what's happening and the changing tax environment, what would your recommendation be? I mean, I know it has to be an individualized, you would have to talk with someone, but what is your take on these Roth 401k options that companies are now offering?
Well, I think it's a tremendous opportunity, especially if you're younger. I mean, like we all know, when you put money in, you pay the tax today, but it grows tax-free, and when you pull it out, it's tax-free, and that's a tremendous opportunity because of the compounding interest Tim mentioned. And so that's a huge benefit. And but if you're somebody that's close to retirement, we really need to do an analysis to determine, does it make sense to put money in the Roth? Just because you're so close to retirement, your income is probably the highest it's been, right? Usually, your last few years of retirement or before retirement are your highest income years. And so you may need that deduction right now. And so the biggest thing that I always recommend people to do is to sit down with us, let's put together a tax map, let's see where they're at. And then we can determine, should we put all of our money in the Roth? Should we put some money in the Roth? The other thing that's important to consider is a lot of employers, this is a new plan for people, for the employer, and so they don't always match on the Roth side either. So you really want to take that into account too. We may be giving up that benefit of getting that contribution from our employer if we're putting money in the Roth.
Right, and you don't ever want to leave that free money on the table with the match. For sure.
Absolutely.
Yeah, awesome. Well, what else would you say, Jeremy, to that? About the whole, I'm sorry, Tim. I'm looking at Tim and I said Jeremy.
It's all good.
It's a little early here today.
I'm starting to gray. I'm trying to catch up, okay? So here's what I tell our viewers. Again, because there's no one size fits all, we need to look at your individual situation. And so what we do is when somebody comes in, we sit down with you, we look at all 5 areas of the retirement compass: income, investment, tax, healthcare, and legacy. We're talking about taxes. There could be some strategies to lower your overall tax bill, whether it's a Roth conversion, where we're going to move money from pre-tax to post-tax. Those are really popular, but it's not for everyone. We can tell you, as part of our retirement readiness review, we're going to run an analysis. We're going to look at the whole picture, and we'll tell you, hey, if you do a Roth conversion, it's going to save you and your beneficiaries $200,000, $500,000. I've seen over $1 million that it could potentially save you over your lifetime, depending on how long you live, of course. In taxes alone, not because you're making more money, but in taxes alone, just by having a smarter tax plan, But again, it starts by calling the number at the bottom of the screen, and we'll look forward to visiting with you soon.
Wow, Tim, Jeremy, thank you so much. To our viewers at home, if you want to be able to engage in this strategic tax planning for yourself, working with the team at Stonebridge Wealth Management, it's very easy. All you need to do is just call that number on the bottom of your screen, 866-256-7778. You're also welcome to take out your smartphone. Simply scan that QR code in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few simple questions, and then a member of the team will reach out to you to set up your complimentary retirement readiness review that way as well. We have a lot more to get into on tax saving strategies. Stay with us, more after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to the Retirement Compass. I'm your host, Kristen Oakley, and I'm here with Tim Kulhanek and Jeremy Gove from Stonebridge Wealth Management. We are talking today all about taxes. And I know, Tim, you even shared that you all have been able to see how people can save over $1 million over their lifetime in taxes. And that's why engaging in this strategic tax planning is so important. I want to ask, I know you've also shared that it's been said that when folks retire, the way they get taxed on their income becomes a lot more complicated. So I'd love to hear what you have to say about that.
Yeah, so I mean, if you think about it, when you're working, your employer is really doing your tax calculations for you because they're withholding taxes for you. So you get your your paycheck. They do the standard deductions and they deduct your health insurance and all that stuff, and then they pull the tax out and they send it to the federal government or to the state. And then at the end of the year, you file your tax return. There is some tax calculations that are done, but the majority of it's done by your employer. Once you retire, that completely changes because now you no longer have a requirement to withhold taxes from distributions that you're getting. So if you think about it this way, if I have an IRA and I have income from my Social Security and maybe I have a pension, if you're lucky enough to still have one.
Right.
So I'm getting money out of my pension, my retirement, and so how much should I deduct from my IRA? That's a great question. Nobody really knows the answer, right? I mean, so without a tax map to really identify where you're at in your tax bracket, a tax map is a great tool because we can see exactly where you're at in the bracket, how much room you have before you go into the next bracket. And so that will tell us how much should we deduct. And so it's a great tool, but that's why taxes are so much more complicated once you retire than when you were working.
Right. So let's talk about this tax map in a little more depth because I'm sure that is such a helpful tool for folks. So how do they go about engaging in that process with you?
Yeah, so first of all, everyone who comes into our office, whether it's from one of our workshops, radio program, our viewers today, they're entitled to their own complimentary personalized tax map.
That's awesome.
So here's what that looks like. We're going to show you, to our viewers out there, we're going to show you your taxes in a way you haven't seen them before. We're going to show you your finances in a way that you likely haven't seen before. So what we're going to do is we're going to lay it out in a really easy, kind of like a mountain chart illustration. We'll be able to show you, okay, if you just keep going the way you're going, okay, here's where you're going to be. Here's the taxes you're going to pay, and you're just going to have to bite the bullet and write that check to the IRS, right? if you decide to engage, for example, our team with some strategic tax planning, here's some things we can do to try to lower your taxes. One of my goals, I think all of our team's goal, is to reduce your overall tax liability or tax burden over your lifetime by 20 up to 50%. The goal is zero,
right?
Eventually to get to zero. It takes a lot of work. There's some heavy lifting, but for the right situation, it can be done. It's not for everyone, and it might not be for all of our viewers out there, but there's a chance that that's possible. And the really powerful thing is the tax map will show you exactly where you're going to be in the future, help you avoid the pitfalls of paying extra, for example, for Medicare, like what we call an IRMA, or income-related monthly adjustment amount. As Jeremy said, there's just way more things in retirement you have to try to keep track of when it comes to your taxes that you never had to think about while you're working.
For sure. And I've used this analogy before, but it's like a big jigsaw puzzle, and it's almost like all these different pieces, they have to be fitting together and working together, because the goal is to help you pay less to the IRS. We don't want to have you pay any more than you're entitled to, right? It's not tax evasion, it's tax avoidance in the best possible way.
Yeah, and that reminds me of a client that I just recently got. He became a client. So he was actually retiring, and when I was looking through his 401k, he had stock in his 401k that actually was his employer's stock.
Okay.
And so that allows us to do some different planning. And the ironic thing is, because of COVID, the company that he worked for, the stock just skyrocketed. And so his cost basis, when we started to do an analysis, his cost basis was around $30,000, but the stock was worth $1.1 million. Wow. And so if he were to just retire and do what every other advisor would tell him to do and roll that over into a 401k, he's going to pay tax as ordinary income on that $1.1 million. But because of putting together the tax map and doing the tax analysis that we did, we're able to determine, let's roll this over to a different type of account, not put it in your IRA. And ultimately what he ended up having to do is pay tax on as ordinary income, as capital gains instead of ordinary income. And the benefit of that, just in that one calculation, we saved over $240,000 in taxes.
Wow. Oh my God.
I mean, and so if you think about it, there's a lot of people out there that are wondering, do I need an advisor? Does it cost me too much? There's no way this client is ever going to pay me $240,000 for the rest of his life and for the rest of his kids' lives.
Yes.
So it's really a no-brainer to sit down with us and walk through the retirement compass, specifically look at the tax analysis, because we really earn our money in that space.
For sure. And I know you've shared on the show previously that what you like to do is stress test people's retirement plan. So talk a little bit more before we have to go to the next commercial about what you mean about stress testing someone's current retirement plan that they may have.
Sure. We talk about this a little bit when we're talking about investments, and that's usually what people think about is, oh, you want to see what if the market's down.
Right.
But that's not really the only thing that I think we have to worry about. We have to worry about things like Social Security. We talked about on a previous program. By 2034, the trust fund is kaput.
Right.
We got to worry about tax rates. And so think about it this way. I'm going to make a deal with Jeremy and Kristen here.
Okay.
I'm going to loan you each $500,000.
Okay.
And you don't have to pay me anything for 30 years. Is it a deal? Sound good?
Depends.
Yeah.
Come on.
Like so much in financial
let's keep
services,
going.
it depends.
You don't have to pay me back for 30 years. There's no monthly payments. It's a great deal. Here's the thing.
What happens 30 years from now? That's what I want to know.
Okay, I'll get to that. So at the end of 30 years, you have to pay me back principal plus interest.
Ooh, no, thank you.
Well, why not?
Well,
You don't know what the interest rate is. What if it was only 1%? But here's the thing, right? I get to decide, okay? I get to choose what the interest rate is 30 years from now. You have no say over it whatsoever. Still sound like maybe a good deal?
No.
Here's what's crazy. For our viewers out there, that's the deal we're effectively making with the government, with the IRS, if we just ignore this problem and keep all of it in our pre-tax accounts and don't do anything about it. Again, there's two types of people in the world. There's those who just sit and take whatever comes at them, and then those that take action to alter their circumstances in order to serve their purposes, in this case, tax mitigation. We can help you with that as part of our retirement readiness review, as you see on the bottom of the screen. But just take a simple phone call today, 866-256-7778, or you can go to our website, stonebridgeiwm.com. Just click request a meeting, and someone on our staff will be getting a hold of you very soon.
Tim, Jeremy, thank you so much. To our viewers at home, we are going to take that quick commercial break, but if anything that you're hearing today is just piquing your curiosity, your interest, you might already be working with another financial professional, but they're not talking to you about this stuff. We encourage you. You can't get a second opinion from the same person who gave you a first, so take them up on this offer. Call that number on the bottom of your screen, 866-256-7778, or you can also get connected by scanning that QR code. We have more strategic tax planning strategies for you right after this.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Welcome back, Nebraska, to the Retirement Compass. We are talking today all about engaging in strategic tax planning and helping you navigate the ins and outs of that successfully. And I think when it comes to taxes, it's almost like folks are playing a game that they haven't been given the rules to.
For sure.
Right? And so we want to try to unpack that and help people understand the rules. And then, of course, I know you are so passionate, which I love, about helping folks really engage in a solid strategy that meets their individual needs. But I'm curious, when it comes to recent tax law changes, we hear legislative risk, and really what that means is you gave that wonderful example before. You were going to offer me $500,000. I didn't have to pay you for 30 years, but then you were going to choose what the interest rate was. I like, no deal.
I got to get paid too.
But that's the problem, right? Is that we don't know what the government's going to do.
Yep.
But there were some recent tax law changes that are important to present. So I'd love to hear your take on those for now.
Yeah, for sure, Kristen. So two would be the Secure Act of 2019 was Secure Act 1.0, and then Secure Act 2.0 was passed in 2023.
Right.
And there were some major changes, especially for retirees, not just for retirees, but for our clients who, let's say, are 70 years old or beyond that. There's a big thing that changes in retirement. So, when you're working, like Jeremy said, you got your W-2 wage for a lot of folks out there. The company withholds for taxes, and then you get your check and you go on with your day. But in retirement, you've got Social Security. Am I going to pay taxes on my Social Security? You might, by the way, and in fact, it might be up to 85% of your Social Security that's taxed.
Yeah, up to 85%. It's amazing how many people don't realize that.
No, and it was never supposed to be taxed, right? That's not how it was set up. That wasn't the deal. But again, legislative change.
Right. Yeah.
But you have something called a required minimum distribution. And for our viewers that don't understand what that is, the government has basically said, hey, we went into a partnership with you on your pre-tax accounts, your IRAs, your 401ks. And so eventually we want our cut, okay? So once you reach a certain age, this magical age called your required beginning date, you have to start taking money out of that account. And if you don't, we're going to smack you with a penalty. Now, the good news, if there is good news, is that the government has reduced that penalty down from 50% of what you were supposed to take out that you didn't, down to 25%, potentially as low as 10%.
How generous of them.
Yeah, I mean, it's a really great deal.
Down to 25%, right?
Here's the thing though, Kristen, that was the largest excise tax in the Internal Revenue Code up until this point, right? And so with Secure Act 2.0, they've moved the required beginning date back from, originally it was 70 and a half, and then Secure 1 moved that to 72, and now we've got it all the way out between 73 up to 75 starting in 2033.
Right.
So there's some good news there, which means we've got more time for tax deferral, but if you're like Jeremy and I, you've got more time for tax planning before that date hits and those required distributions kick in.
Right, absolutely. Well, I know, gosh, the show always goes so fast, but I want to ask, I've heard you talk about a spousal tax trap as well. So can we hit on that before we have to wrap up the show today?
Sure, you want me to take that one?
Yeah, go
sure.
ahead.
Okay, so spousal tax trap. Again, this is why planning is so critical. when you look at the retirement compass, we've got income, investment, and we're talking about taxes today, right? Well, one of the things, if you look at the actual retirement compass document that we send home with all of our clients, is it talks about spousal planning. So what does that mean? Well, one thing is Social Security.
Right.
The survivor keeps the higher of the two, but not both benefits. There's always a drop of income at the death of the first spouse. The thing that people don't think about is they think, I'm going to be in this tax bracket, I'm in the 12% bracket, I'll be in the same tax bracket for the rest of my life, they think. But what if someone has an earlier demise than they had expected, right? You know, life happens. Well, all of a sudden, that required distribution gets shifted to the survivor, and they've got all of that income on top of their required distributions, and their tax bracket, the room they have effectively gets cut in half. So they could go from 12% to 24% pretty easily.
Because now instead of filing married and joint, now you're filing as a single person. And so I've heard this known as the widow's penalty.
It is. Absolutely.
Right? Because now you're hit with all this extra income, but you now have bumped up to a higher tax bracket.
Yep.
Yes.
And then here's the other thing we got to think about. Okay, so that's 12 to 24 based on today's rates, but that could be 12 to 28 based on 2026 rates, or if you talk to a lot of economists. So I mentioned on one of our last programs, Larry Kaltikoff, right? So I said he was at Brown. He's a Boston University professor of economics. And what he has said, just to make this very clear to our viewers, this isn't Tim or Jeremy making this up. He said that in order for the U.S. government to make good on all their promises for Social Security, Medicare, Medicaid, and pay the interest on the debt, they would have to have roughly $239 trillion in a bank account today in order to fulfill those promises. And that doesn't leave any money left over for, you know, education, national defense, some of those things. So if we think that we're in a high tax environment today, and again, a lot of people get advice from their tax preparer to say, I want to lower your tax bill this year. What Jeremy and I and our team of lead advisors at Stonebridge are worried about is keeping more money in your pocket down the road, because it's not what you earn, it's what you keep that really counts.
What you keep and how you can convert it into income for yourself, right?
Absolutely.
Well, gosh, I know that this time goes so fast. We have so much that we could get into about taxes alone, and we hope you found this to be helpful and beneficial. One more time, why don't you share with folks what's going to happen when they call that number today? Yeah,
give us a call. Looking forward to seeing you soon. You're going to be able to connect with one of our friendly staff and come in for a no-cost, no-obligation retirement readiness review. And we're going to go through your whole plan. We'll look at income, investment, taxes, healthcare, legacy, just to make sure you've got the right pieces in place. If there's any changes that need to be made, we'll give that information to you and you be the judge. Call the number below and we'll look forward to talking to you soon.
Wonderful. Tim, Jeremy, thank you so much. To our viewers at home, thanks for watching. We love you, Nebraska. Have a great week.